I'm Scott Starratt with Starratt Wealth Management at Canaccord Genuity Wealth Management. So we thought we'd take another opportunity to kind of update what's going on, what we feel is going on in the markets. It's been a month since we chatted last time. And so this time the real focus that we're looking at and what I wanted to start things off with is debt and liquidity. So put in perspective, so right now, end of August, unemployment in North America was between 8 and 10%. You had, who knows what's going to happen with COVID, with a vaccine or with kids going back to school, whether there's going to be spikes or continued shutdown. You have a U.S. election that could be very tight and may very well be contested, so that we don't know what's the outcome's going to be for some time. And you have the normal geopolitical events going on, everything from China to India to North Korea to Greece and Turkey. So there's always something going on. Oh, and by the way, the stock market's at an almost record high. So there's something in our view that's a disconnect there. The general reason for this given is the amount of liquidity, the amount of money printing that's been happening over the last few months. Not just from the Fed down the US, but really any central bank in the world, whether it be Japan, Canada, the European Union. They've all been printing money, taps fully open, as they refer to it as, and this money has to go somewhere. And so at this point, it's going in the hands of a lot of consumers. In a lot of these consumers are now going to have these payments end, or at least reduce. And so what are they going to do if they're not working or are underemployed? So this free money is great. I mean, we're all going to have to pay for it at some point, but the free money is great to keep the economy going. But what's the effect that it has to the stock market going forward? And so our view continues to be that there's too much risk in the stock market for the reward that might be given. Now, that's not to say that the high-flying companies of the last few months aren't going to continue to be high-flying companies. All I'm suggesting is that the risk is elevated to the point right now where we definitely have to be prudent, and I think our continued prudence as it applies to how much money we have exposed to stocks should continue the way it is. Like I said, the world is printing a lot of money. Right now, the Bank of America comes out and says that they feel, based on their analysis, that throughout the world, $2 billion per, I get this right here, $2 billion per hour in debt is being bought by the central banks. Huge amount of money, I mean. And so what's the effects of this, whether it's going to be inflation, when inflation's going to come? The Federal Reserve yesterday in the US stated that they feel that they will not be needing to increase interest rates until 2023, if then. And so we're into this situation with very low interest rates, with not a lot of options for people to put their money to work. Cash pays zero. There's some views out there that feel that bonds are going to not return anything for the next decade. And so a lot of people feel their only alternative is investing in stocks. So things are elevated. Prices are elevated in some of these companies. And so, like I said, our view is to sit tight and back up a bit and not put too much money at risk. I think overall client portfolios, what we've seen is a continuation of the last few months. We've seen that the volatility has definitely increased in the market, but for the most part, most client portfolios have not seen a great deal of volatility. One of the things that we've done at Starratt Wealth Management is we've looked at the three buckets quite closely over the last few months. And as a matter of fact, we're still looking at that right now. One of the things we're looking at is in the yield bucket. These would be things like bonds and like fixed income, where you're paid a set amount of income. The issue that we have with this is that if right now the long-term, or let's call it 10-year, U.S. bond is paying a whopping 0.67% per year to investors, that's not a really good place to invest for the longer term. And so some of the funds that we invest in do have some exposure to this government debt. And so some of the changes we've been contacting you about or or will be contacting you about have to do around the idea of getting involved in some of these other types of still quite conservative corporate investments, but you know, some of the funds that are really focused on the non-government debt side. On the market bucket, we're still undergoing our full due diligence there. I think the problem, we were quite happy with how they performed throughout the downturn in December of 2018, as well as we were quite happy with the performance that they achieved through March and April. But one of the things we found was that when we became less defensive, they were less defensive. And so we were thinking, well, if we only have 20% exposure, for example, into stocks, that's great because we're being defensive. But then the funds themselves, some of the funds themselves actually became defensive. And so they went to 30% cash. And so we became defensive upon defensive. And so not to say that we're going to rush out and invest in a whole bunch of risky things by any stretch, especially giving our view that, you know, we're a little bit elevated in prices. But I think that there is the opportunity to maybe look at some different funds or look at adding to some other funds that we have already, where you're looking at it from the standpoint of, are they going to be invested in the market? Are they going to be able to outperform the market when we're invested with them? And we'll worry about how much money we have exposed to the market at that point. Like I said, we'll talk about that in the coming reviews, or if we've already had a review, we've probably already talked about it. I wouldn't expect that to, in the market bucket, to happen until October, November. Other than that, I think that we're really continue to be focused on looking at clients and how their income is set, making sure that the income is looking good. So definitely get in touch with us if you have any income concerns at all. And for some people, because they're spending less, they're finding that they might not need as much income being put into their account every month. Other people feel that expenses are a little bit higher because of some health costs or helping out maybe some family members, and so they need a little bit of extra income. Just let us know at one of the reviews or any time in between. Jim and I are more than happy to discuss that and see if there's any tweaks that are going to be necessary. Like I said, I think going forward, we're going to be really focused on making sure that the assets are safe, making sure that we're well protected. There are going to be opportunities to take advantage of downturns, and so we want to make sure that we're able to do that. But overall, although we're quite happy with how things have recovered and performed in the last 6 months, really, we're really focused on making sure that that continues and not putting things at risk when it's not a good time to take a risk. As always, if you want to forward this video to friends, family, feel free. We're more than happy to sit down with anyone, Jim and myself, to go through kind of our philosophy and talk to them about their particular needs, or just simply to answer questions that they might have. It's surprising how many questions we've answered lately about mortgages, or insurance, or some basic financial planning stuff. It's been quite busy talking to people about that. So again, if there are any questions at all, please do reach out. Hang Yi and Angela are more than happy to chat as well. So we look forward to talking with you soon. And if you're not a client, hopefully we'll have a chance to have a socially distant coffee and be able to talk about what's going on in the markets further.